it's more than likely you get the worst stretch of U.S. economic data between now and October. Again, if you think about the comps for pretty much everything in the economy, steep into their inevitable crescendo over the next 3 months. So you're talking about data through July through September, which obviously will be reported from August through October. And then you also have Q3 earnings season beginning in October, which is the peak cycle comp compare for that as well. This morning you got outstanding numbers out of Walmart, which continue to highlight and terrible numbers and terrible guidance, rather. More importantly, the guidance out of Cisco continues to highlight the bifurcation between the U.S. consumer economy and the domestic manufacturing economy. If you go to slide 27 there, in that macro themes deck, Josephine, we just sort of highlight the first two rows, or the third and fourth row in that table really just sort of highlights this bifurcation I'm discussing. So what we're showing here is just the progression on a quarterly average basis of some of the top 10 drivers in our nowcast framework for the U.S. Economy. And what you see is industrial production, which is where we're going to get that number for July in 10 minutes here, or 11 minutes here. Industrial production continues to be much worse, or trending much worse than retail sales and other metrics of consumption growth. You saw that this morning, actually. We got a pretty solid retail sales figure for the month of July, sort of bucking the trend. Retail sales accelerating on a headline basis, 10 basis points to 3.4%. Against a steeper compare, so that's obviously a really good number. The control group accelerated 50 basis points to up 5.1%. Both of those figures are the best since May 18, so a little bit on the margin moving towards out of quad 4, but still the model continues to signal quad 4. But again, certainly this bifurcation, the U.S. consumer economy, this consumer's good narrative continues to hold up expectations for the U.S. economy and sort of perpetuate our view that we're actually unlikely to see a recession between now and over the duration of our next 12-month time horizon. But again, how sustainable this is, we'll see. Clearly, consumers are starting to dip into their savings. One of the things we track within the jobs report is aggregate wage and salary income. When you combine total employment growth, total wage growth, and obviously hours worked, and you see that decelerated in July to 4.16%. That was the worst number since October 2017. So again, what this data is indicative of is consumers reaching into their purse strings and obviously supporting consumption with savings. So again, how sustainable that is, who knows? It could, obviously could last for a few months, and that's clearly what's happened in July data. But clearly, the divergence between industrial production, CAPEX, factory orders, the ISM manufacturing. All these things continue to point to downward pressure on the U.S. economy, particularly from the manufacturing side, and that's the data we're going to likely to get between now and October as it relates to Q3 earnings.